So I think Benjamin Franklin said it best when he said, an investment in knowledge pays the best interest. And that's definitely true when it comes to investing your money. Did you know the average investor underperforms the market by a huge margin? It's estimated that the average investor only gets 2.1% to around 2.9% annual returns, while simply buying and holding any asset class would have earned at least double that, and a diversified global index would have earned them over 10% compound annually since 2003. And what this means to the average investor? Well, it means they lost out on over £500,000 in return. So why are so many people leaving money on the table? More dedicated investors use a tool called Investor Policy Statement to guide their investment decisions. It's a bit like a roadmap to financial success. It's made a huge difference to my investment approach. So in this video, I'm going to show you how to create your own IPS so you can make a difference to your wealth. Firstly, let's cover the benefits of an IPS.
He who fails to plan is planning to fail. Winston Churchill.
So you might be wondering, why do I need an IPS? Can't I just wing it? Having a well-defined IPS offers numerous benefits. It helps you define your investment goals. An IPS forces you to think about what you want to achieve with your investments, whether it's early retirement, buying a dream home, or leaving a legacy for your family. It clarifies your risk tolerance. An IPS helps you understand how much risk you're comfortable taking, which is crucial for making sound investment decisions. It outlines your investment strategy. It documents your asset allocation, how you divide your investments across classes like stocks, bonds, real estate. It also helps you chasing fads and clarifies decision-making process. It also keeps you on track. It helps you stay disciplined, avoid making impulsive decisions that could derail your long-term financial goals. Finally, I'd say it actually improves communication, whether with your family members or a financial advisor. It helps you communicate your goals and expectations clearly. So you can think of an investment policy statement as your personal financial constitution. It's a sort of guiding document that will help you make informed decisions about your money. So what are the key areas that are covered in an IPS?
You know what you own and you know why you own it? Peter Lynch.
When you develop your own personal IPS, you'll cover pretty much all aspects of your investment journey. So let's explore the key areas. Firstly, what you have to have in mind is your own personal circumstances, like your age, income, employment, family situation, as well as your investment knowledge, as this will feed into your own personal policy statement. Your investment objectives. Here you're going to define your specific investment goals, including the returns that you want and over what time horizons. And then there's your risk tolerance. This section's crucial. You assess your ability and willingness to take risk. Now, there's various risk questionnaires you can take across online. I'll link a few here, and they'll help you determine how comfortable you are with the fluctuations of the market in your portfolio. And then there's the constraints and assumptions you have. There are limitations and restrictions you might have around your investments. Things like the liquidity needs you have. Do you have upcoming expenses or require available cash? The time horizons you're working over. For instance, when would you need to access your investments? Are there any tax considerations? How can you structure your investments to minimize taxes? There may be legal and regulatory issues you need to consider. There'll probably be some unique circumstances. There's specific to you, special considerations, and this might include things like ethical investment preferences. Well, key considerations is your asset allocation. Based on your objectives, risk tolerance, constraints, you need to determine your asset classes that you're going to invest in, be it stocks, bonds, real estate, and the strategy you're going to approach this with. And then there's the investment strategy itself. This outlines the specific types of investments you'll use, such as index funds, ETF, or individual stocks. You'll also decide whether you want to actively manage your investments or take a more passive approach. There's then rebalancing and monitoring. You need to establish a plan and review it regularly to make sure your portfolio is balanced appropriately, and if you're keeping the desired asset allocation and investment strategy alive. But finally, there's the actions you need to take to realign your investments alongside your investment policy. So let's jump to an example investment policy statement that I've created. So this template includes a couple of elements. I've included also a simple budget template for people to use, just a one-pager, and also a net worth tracker. Again, quite simplified, but they're included in the template also. But what we're interested in here is the investment policy statement, which is here. And it's split between two sides. One is the questions you should ask yourself and pose yourself, and the other side is some of the answers I've given on an example template. So if I move over to the key questions that you can ask yourself to create a investor policy statement. What we'd start with is the investment objectives. Specifically, what are your investment goals? What are your financial goals? What are you looking to achieve? Over what time horizon? What's your risk tolerance? And I included some links to specific tools you can use to work out your risk tolerance. And what's your position when it comes to things like debt? You're looking to pay it off, or you're looking to utilize it? So those sort of questions. Then we sort of move on to constraints. We're looking at your specific circumstances and your specific constraints. So it might be related to you personally. For instance, you're going to give up work shortly, or you've got a particular retirement income coming in that you need to take into account, or you've got certain expenses coming. So what it takes into account is things like what's your current financial position, what are your liquid asset needs, or your liquidity needs, how much income do you need to get, for instance, any tax considerations you have, your low rate taxpayer, high rate taxpayer, are there any legal or regulatory impacts? Maybe that you've moved country relatively recently and you need to take that into account. Are there any ethical concerns? Do you want to invest in ESG or similar? And finally, on this set of questions, although you can add others, is are there any income assumptions or constraints that you might have? Then we move on to the investment strategy and philosophy. And what this is trying to do is marry your approach, how you then embed and deliver against those objectives and those constraints. So what asset classes will you invest in? Stocks, bonds, real estate, commodities? And I'll come on to ways to consider this in a second. What's your target asset allocation? Will you use active or passive management funds? Will you rebalance, or how often will you rebalance? Will it be on a percentage basis, on a benchmark basis? Will it be on a periodic basis? And then we've got things like, if you're coming up to withdrawal, what will be your withdrawal approach? Again, I'll touch on some of this in a moment. And then if we move down to monitoring and evaluation, clearly you need to make sure that the portfolio is performing in a way you'd expect against your investment policy. So it's important to consider that and review that on a regular basis. So what benchmarks are you setting, and how close are you to those benchmarks as you go along? How often will you review your portfolio? What circumstances might trigger a review of the portfolio? Could it be a market dip? Could it be a surge? Could it be that there's been a change of circumstances with your family? So there'll be some things that you might consider as opportunities to revisit the policy that you've created. And then finally, the actions. This is critically important and often missed. What are the key actions you're going to take on the back of your position against the policy and the outcomes you're getting compared to your benchmarks to get you closer to what your policy statement is saying that you want to achieve? And then if we move to the left-hand side, I've got an example here. It's basically an example of a way that you could consider this. So under my objectives, any debts with interest over 7% will be paid off before investing. The investments will support a withdrawal of $40,000 a year, growing at 2% above inflation. My net assets will be worth $1 million by 2030. Properties will return 7% capital and income. And then on a risk profile point, the way I've pulled this out is this individual would have 3 time horizons for their risk. A 3-year time horizon where they'll be investing in low risk, low volatility type assets. A medium term, 3 to 8 years, which will look at medium risk, relatively low volatility still, but target to hedge against inflation with some growth. And then a longer term, 8+ years with higher risk and greater growth potential. So the idea is then to consider risk in those 3 time horizons. The assumptions are their job will stop in 5 years. They need to support an income of $30,000. Any gains for capital gains tax need to be taken into account, as do dividends, marginal rate, relief. In here, you'd also include assumptions around what your tax rate is, what you'd expect your tax position to be in the coming years. And we've also mentioned here around their daughter's university fees coming up, and then you'd need to be specific about that. And also that they're looking to actually work 2 days a week, and that will perhaps support other ventures and activities that they're doing. Then go on to the specific strategy and philosophy. Here they're saying how they're going to deliver against that. So they're favouring passive over managed funds. They're looking to invest in index funds and ETFs, and they're looking for them to be diversified across sectors and geographies. They're going to automate it, and they're looking to invest in tax-efficient wrappers, of course, ISAs, junior ISAs, pensions, premium bonds, etc. And they're looking to do that as best they can as a family, so to utilize all their allowances across the family, the husband, the wife, and in some cases the kids as well. They'll maximize pension contributions where they can. They'll also look to minimize fees. Critically important, they're saying here that they want to have nothing over 0.22 when it comes to the expense ratio for investments. They'll pay off credit cards in full every month, and they'll utilize methods like bed and ISA and bed and SIPs to be as tax efficient as possible. And here you can see they've been specific about the horizons. They've got 3 years horizon. They're looking for highly liquid, low volatility assets, things like high interest savings, premium bonds, and short-term gilts. For 3 to 8 year period, they're looking at low intermediate volatility, but there will of course be more volatility because we're looking for better returns to beat inflation by 2%. Here it's their property rental income and the capital growth on that, any intermediate bonds they've got, and dividends. And then 8+ years is a focus on its higher volatility, but of course what you'd expect to come with that is higher return, things like global funds and diversified index, ETFs, etc. And on the right-hand side here, you can see a simple way then for them to monitor their asset allocation against all those different asset classes, where they are today and their target over time. Continues then they talk about the withdrawal approach. This person has only got a few years before they start withdrawing, but what they're looking to do is withdraw from the 3-year pot, bucket above first, and then they'll top that up from pot 2 and 3 on a yearly basis. And once the asset allocation has been achieved, they'll rebalance, and they'll maintain the 3-year spend as a key and critical period, key and critical point. That's really important to what they're doing. And then it comes to behavior and mindset. This of course is very important. A lot of the losses that people make are because they react to the market inappropriately when they should actually just be consistent and waiting for the market to recover. They'll not panic sell. Any changes to the types of assets they invest in, they'll pause before they do it. It may be they just think overnight before doing it and don't instantly react. Or it may be that you put in here that you'd wait 2 weeks before you change out your assets. But at least then there's some inbuilt buffer to stop them doing it. They'll automate wherever possible. They'll ensure their family is aware of the financial situations. Again, the investor policy helps with that communication, and then they'll pull together a plan B, and I'll come on to that in a second. And then we cover monitoring and tracking. This is when you review against the benchmark. So review the portfolio at least quarterly, in this case they will, and they'll look against those particular benchmarks and their asset allocation. So in this case, their benchmarks are cash or cash type assets. They're looking to match inflation, bonds type assets, inflation plus 2%, property, inflation plus 2%, and shares, index type funds, ETFs, inflation plus 4%. Again, these are to some degree arbitrary, but there are benchmarks to consider then as you go forward. Let's quickly look at the fallback plans. So not everything goes according to plan, of course, and it's worth considering what fallbacks they have. This person will look to, with plan B, reduce their living expenses and perhaps research cheaper homes or ways to fund their home in a cheaper way. Plan C would be to sell their home and downsize, and plan D will be to get a job, a part-time job. So that's the sort of an example of a policy statement, investor policy statement. But of course, your flavor of that would be very different to this flavor, but it's a conscious thinking through the process that brings out the benefit. And here we've got finally the action. So from that policy statement, you would then draw out the short, medium and long-term actions that you need to follow through. So for this one, they're going to cancel their credit card. They're going to make sure their national insurance contributions are up to date. They're going to transfer their pension from one pension to Vanguard. They're going to look at their investment fees, etc. So you can see that this draws out the actions against that policy statement.
The individual investor should act consistently as an investor and not as a speculator. Benjamin Graham.
As you can see, creating an IPS can be a powerful way to take control of your financial future. It helped me clear my head on the approach I want to take with my investments. By clearly defining goals, understanding your risk tolerance, and outlining your investment strategy, you put yourself in the driving seat and increase your chances of success. We have to remember, of course, that investing is a marathon and not a sprint. And by having a sound IPS in place, you'll be better equipped to navigate the inevitable ups and downs of the market and stay focused where it truly matters.
The best time to plant a tree was 20 years ago. The second best time is now. Chinese proverb.
So don't wait any longer, start creating your own IPS today. I've included a downloadable template in the description below so you can get started. And if you have any questions, feel free to leave them in the comments and I'll do my best to answer them. And if you're looking for a beginner-friendly Budgeting template, I've created one and it's accompanied by a video and it's in the link above. If you're looking for ways to track your net wealth, I created a video, you can see the link above, and it's accompanied by a simple template you can use to track your net wealth on an ongoing basis. If you enjoyed this video, please like and subscribe and click on the notification bell and you'll be advised of the next videos as they're released.